More than half of the personal loans taken are from Gen Zs. Going on a vacation that they can't afford, take a loan. Buying an iPhone that they can't afford, take a loan.
Typical mistake which young people tend to make is that they get into using the credit card or debt as a proxy to living a great life. When you see an iPhone, you remember the debt. At least you should put aside 10% of whatever you're earning and then slowly hike it up to 30%.
Somebody who is in their mid-30s. What are the mistakes that these guys are making?
Acquiring a house very early in life is not really a great idea.
When would you say is the right time to buy a house?
Yeah, so one of the mistakes people do in the retirement phase is help their children. They gift away that money to the children, and even assuming you really have taken that call, have your name in that house.
I'll retire in 15 years. What is the formula you should apply to know, okay, if I have this corpus, I can quit my job and live off this savings until I'm 90?
If you have, let us say,
So Suresh ji, is there like a certain kind of a income level or a wealth level that I need to achieve, after which I need to seriously start thinking of hiring somebody to manage my money full time?
yeah, so if you want a straight answer, I would say everybody and anybody will require a financial planner. The first explanation which I'll give is, for anything that we do in life, we generally have a plan. So even if we want to go on a picnic, even if it is a day out, we are going to the movies, we have some plan. If it is a marriage, we plan for 6 months, 1 year. So for everything in life, we plan a lot. But unfortunately, as far as finances are concerned, which is really important, and we are willing to spend 30, 40 years of our core life, the youth in that, we don't have any plan. So that's an unfortunate part. Now let me come directly to what you are asking. Who requires a financial plan? In fact, I would say a lot of people tend to think that people who are loaded with money, they require financial plan.
Yeah.
Of course they do. I'm not disputing that. But people who have slightly less, they are less well endowed, those people require planning even more, because the margin for error in their case is a lot less. So they require planning more as compared to people who are loaded with money.
Got it. So you talked about the margin of error which people who have lower income typically can make, due to which they really need a financial planner. So let's go deep dive into that. Let us say I'm somebody earning 50,000 rupees per month.
Correct.
And I'm 25 years old. What are the stupidest mistakes that you've seen an average 25-year-old make who is earning 50,000 rupees per month, due to which they will not be able to, become financially free?
So what happens with young people is that, and especially who are very, very young, say 22, 25, that kind of thing, the moment they get their jobs, they want to do a whole lot of things. Okay?
Yeah.
Whether it is a vehicle, whether it is a world tour, or whether it is gifting their near and dear ones, or whether it is a laptop or any other devices and things like that. There is absolutely nothing wrong with that aspiration. It is only a question of sequencing. It's only a question of first earning that money and then spending. So coming to the mistake, the typical mistake which young people tend to make is that they bunch up everything and they get into using the credit card or debt as a proxy to living a great life. So, in my opinion, it should be done over a period of time. Getting into a debt trap, and you're talking about a person who is earning 50,000. I know of people who are earning 1.25 lakhs who are in a debt trap. So anybody can get into a debt trap.
What is the explanation of a debt trap? Can you give an example?
Yeah. So if somebody is earning, let us say 50,000, okay, and they are having certain money for their own spending, they have to service their EMI, and at the maybe 15th or 20th of the month, they don't have the money. So money is all gone. So then you're very, very clearly in a debt trap, and you're swiping or borrowing more and more, and that's a spiral. But this is a problem which one should guard against. What I will typically suggest a 25-year-old or anybody who's young is to first, instead of paying the EMI after buying, I would say do the exact opposite. Save that same money, probably what you put it on EMI, you accumulate that money and you buy whatever you want. So it means that you will be probably deferring your purchase slightly, but at the same time you will be able to enjoy that much more than having a debt burden on your head. And always, when you see an iPhone, you remember the debt.
Right.
So in the other case, it is actually you'll be enjoying that thing.
So I was just looking at the stats, and personal loans have really shot up in India. And the surprising thing is that more than half of the personal loans taken are from Gen Zs. Going on a vacation that they can't afford, take a loan. Buying an iPhone that they can't afford, take a loan. Having a wedding which you can't afford, take a loan. Right? And this is very common today. Now let's go one step further of somebody who is in their mid-30s. Right? This is where you are in something known as a midlife crisis. Because your responsibilities have increased in life. You are married now, probably have kids. And your parents are also aging. So you have to take care of your parents and your kids and your spouse. So you are squeezed. So at the age of 35, let us say somebody is earning 25 lakhs per annum. What are the mistakes that these guys are making that you have observed at the age of mid-30s?
See, as far as the mistakes are concerned, as far as the thinking is concerned, a person who is making mistakes at 25 will continue to make the mistakes in 35. I mean, unless, of course, they have had a jolt and they have realized that this is not going to be sustainable. The mistakes which people make at 35 are very similar to what people make at 25, because now you have a family. At 25, probably you are the only person making the mistake. Now the magnitude of the mistake and the number of mistakes that you're going to make are also going to come from your spouse, from your children, from various other people in the family. So if you have a propensity to throw money or live a wonderful life, I mean, you want to increase your lifestyle, the mistakes are going to be something similar. You will get on to more and more debt. So that is one of the primary problems that I see, number one. Number two, the other problem which I see with people is, like you mentioned, somebody earning 25 lakhs. That's a huge income by Indian standards. Okay. So a lot of people do not save enough of whatever they are making. Somebody who is at 35, it means that probably 12, 13 years at least they would have been working. And we have seen a lot of people who are at 35 who are having, say, 20 lakhs, 25 lakhs kind of thing. It should have been a lot more.
In terms of income or?
In terms of assets which they have invested.
You mean savings?
Savings. How much ever you are earning, it may be even 20,000. So at least you should put aside 10% of whatever you are earning. So that is where you start. And then slowly hike it up to 30%. What I'm saying is, if you look at the trajectory of income in the early 20s to up to 30s, I mean, it's a very steep curve. It's not going to be like this. And
Correct.
Probably at 45 to 50 it may be like this.
Yeah.
But here it will be like this.
Correct.
So the income is going to tremendously increase. You are probably going to quadruple or much more than that.
Correct.
In a matter of 7-8 years.
Yeah.
But I reckon that a person at 35 should have much more than, let us say, a 20 lakh figure.
Now let's talk about some important life events which happens in everybody's life.
Yes.
You would have worked with clients who are in their 30s as well as their 60s. Yeah, you have seen everything.
Yes.
So in that time frame, you're going to get married, you're going to have kids, and you're going to buy a house, you're going to buy a car. These are all important life events. Is there any pattern that you have observed that people usually follow in terms of achieving these different milestones, which is also financially good? Like, for example, there would be one client of yours who might buy a house at 30 versus another client who would not buy at 30, will delay till 45. So what are the patterns that you've observed, and what do you advise as my financial advisor? Because these are more important decisions, I would say, than picking the next best mutual fund. Because this can really change the course of your life.
No, absolutely right. You're absolutely right.
The sequencing thing you're talking about.
Sequencing is very, very important. One of the important things that people aspire for is buying their own house, and I mean, rightly so, right? It is only a question of when you should acquire your house. So I don't have any problem about somebody wanting a house, but at what point? So I'll just dwell on this a moment.
Yeah.
See, acquiring a house very early in life is not really a great idea for multiple reasons. So the reason number one is that people who are in their early stage of their careers, which may be in their 20s or early, even late 30s, okay, till late 30s, will be willing to relocate, will be willing to pursue their career in whichever part of the country or outside the country. So in that situation, they are footloose and fancy free in that sense. I mean, they may want to go wherever they want. So in that sense, I mean, buying a house in one place may be more of a negative from that point of view rather than actually a positive. So the first thing is, see, for example, somebody may be from Mumbai and somebody may eventually want to come back to Mumbai even today if they are in Hyderabad or Chennai or NCR region or wherever. But in pursuance of their career, they may go here and there. My point is, first and foremost, you have to accumulate the money enough to put that upfront money, which is at least 20%. Ideal amount will be maybe 30, 35, maybe more than that. Okay, but let us keep it at 20%, at least 20%. Now, you also have to make that determination in which city you are going to settle down. Okay, when I talk about settling down, especially for people who have kids, I mean, who are married and who have kids, once you are able to take that call, then I think buying a house makes sense. So only when you have decided which city you want to settle down, okay, you are very clear about that, you should buy a house. Otherwise, you will buy a house, it will be occupied by somebody, you will be paying EMI, you will go to another city and you will be on rent. It also happens that after 4 or 5 years, they like that city so much, they buy another house there and they get transferred. So these kind of things also do happen. So typically all these things, whatever I'm talking about, typically happens between 35 and 40 normally.
So today if I'm spending 1 lakh a month and if I'm retiring 15 years from now, so meaning I'm 45 today, I'll retire in 15 years. What is the formula you should apply to know, okay, if I have this corpus, I can now relax and I can actually quit my job and live off this savings until I'm 90. Is there a certain formula for this?
So there is no real formula like that. But if you have, let us say, about 25 times of your annual expenses, it's a reasonable amount of money to retire.
So that is what you also suggest.
Roughly. I mean, this is ballpark. Okay,
Right.
This is what everybody says, and it's a reasonably good ballpark. Okay, but the fact is, on a case by case basis, lot of things can it can change. Like I'll give one example. Suppose somebody is indisposed in between.
What does that mean?
Meaning they medically become they have a problem and they want nursing support and things like that.
Right.
So the expenses dramatically shoot up.
Got it. So, all right. So now tell me, now once I'm retired, I probably have 2-3 crores of savings. Let's go with that assumption.
Correct.
Now, what are the mistakes that somebody at this point in life could make due to which they could run out of money and then they have to start calling their kids?
Yeah, one of the typical fallacies of people is to think that in the retirement phase, your investments have to be ultra conservative.
Interesting.
So, I mean, there is certain truth in that. It has to be conservative in that there should be capital protection. I understand that, because if you lose the money due to any mistake that you make, you cannot really go back to work and maybe recoup those losses. It's not possible. So that portion I understand. But at the same time, if you want a limited corpus to last for a longer time, you have to get inflation beating returns from some portions of the asset.
Yeah.
So you really cannot escape the fact that you have to put in those assets, some portion at least, you have to put in those assets like equity, maybe gold, maybe real estate, maybe anything else which is appropriate for that person's situation, so that it can give that inflation beating returns and make the corpus work for a longer period of time than if they had put the entire money in the FD.
I'm assuming most of the clients who come to you at the age of 50 and 60 has put 100% in FD.
I would not say everybody, but some people tend to do that.
Majority of them.
Yeah, a lot of people tend to have this opinion that it has to be in very safe vehicles.
Yeah.
And that's definitely a mistake.
Yeah.
I mean, unless you are loaded, if you have 20 crores, you put everything in FD, there is no problem. But most of the people are not there, right?
Right.
So most of the people have 2-3 crores. It's not a bad amount at all, but you have to manage it properly to make it last for 30-40 years.
Got it. So first thing is that being extra conservative once you retire is a big mistake.
Yeah, it's a mistake.
Second, any other mistakes that they make?
Typically what also happens is, especially people in service, at the time when they retire, they get a lot of money from PF, leave encashment, gratuity and things like that. So when a lot of money actually flows in, there are 2-3 mistakes which they do. One is when they see a lot of money in the bank, the thought is that, okay, fine, chalo, let us let us go on a world tour, let us do this, let us do that, let us buy a car. Those kind of things people do.
Right.
So without really realizing that whatever you're doing today will have an impact maybe a couple of decades later. So that is one. Secondly, the way they are going to invest also has sometimes there is a problem in the way they invest. Either they invest ultra conservatively or they go to the wrong people and get the improper investments done. I'll give one of those scenarios where I know people who have invested in some ULIPs based out of the retirement kitty. So if you invest in the wrong vehicles, I mean, I'm not really talking too much about the returns. If the investment per se is wrong, it is going to be dramatically difficult for you to recover from that. Okay, ULIP is still a much better vehicle. People do invest in land parcels and things like that also, thinking that it can give dramatic returns. I have seen dramatic returns coming out of land parcel. I've seen very poor returns coming out of land parcels, and some of them are illiquid. At whatever price, you cannot really get money back.
Right.
So, I mean, we have seen all this, and people also put in a huge amount of the retirement corpus into new homes. That also we have seen. So
Really?
they're not, yeah, it happens.
Okay.
So they are not very happy with the current home. So now they were never able to afford. So now I've got some 2-3 crores out of my retirement whatever corpus. Now let me go for a better home. I'll sell this home. I'll put another 1 crore, 1.5 crore, and go for a bigger home, better home.
That's a
that kind of thing. That also happens, and these things can have a huge effect at a later point.
Interesting. So one is that they try to upgrade their homes at the time of retirement. And the second is that they try to go for some very risky bets like I'll buy a land parcel and that will probably quadruple, triple. I think my dad also falls in that category. He has some land parcel which he's not able to sell.
Yeah.
And I've been telling him for the last 5-6 years, he's like, I'm not getting a good rate. I'm like, what do you mean by good rate? The rate has not changed on this. All right.
Yeah.
Okay. Interesting. So now let's sort of get into the dark side, right? Like, have you observed or heard of stories where a client has run out of money at the age of 70, 75 or about to run out of money and then they come to you? I'm like, what do I do? Has that ever happened?
Yeah, there are people who have come like that and they say, this is all I have, what do I do?
Give me an example with numbers.
So somebody has come to us maybe 2 years back and said that I have all of 12 lakh rupees.
At what age?
He was past 70. I don't remember exactly, but he was past 70.
Okay.
So what do I do? So there is hardly much that we as a financial advisor can. I mean, we are not magicians, right?
Yeah.
We are advisors.
Right.
So then, I mean, we wanted to help him. We wanted to check out what is his background, who are the people who can support him, what can he do, whether he has a house,
Yeah.
where is he living. So all that we found out, but he had a house in this particular example. He had a house, but the amount of money that he was having was very, very less, 11-12 lakhs. And for a future which can be 20 years or more,
Yeah.
is extremely low. He was, of course, spending very little on himself. He was a single person. His wife had passed away.
Okay.
He had children. I think they were also helping him from time to time. There is not much anybody can do about it.
But what mistakes did he do to come to that point?
Yeah. One of the mistakes I have not really talked about people do in the retirement phase is help their children, which is not wrong. Okay, the helping the children is not wrong in terms of acquiring a house or something like that. They put their own money into their sons or daughters' home, but sometimes people don't have that money and still they
Sacrifice.
I mean, fork it out of their retirement corpus, which is again another. This happens from time to time, not in all cases, but it does happen. They gift away that money to the children, and one of the things which we typically tell is that even assuming you really have taken that call, have your name in that house. That is what we tell. This is a practical thing. As financial advisors, we say, let your name be there. If you are putting 70 lakhs, you should be a party to that purchase.
Right.
So, I mean, if in a very unfortunate situation where the children are not really taking care, at least he has a recourse of recovering that potentially that 50-60 lakhs, whatever he has given.
So another major problem I've seen of people trying to retire is that they're not able to get a good health insurance cover. and instead they go for the wrong insurance products. Like we have seen examples where a 60-year-old man is taking life insurance, right? Because they think that's going to protect them, because it is missold to them. Because like you said, at the age of 55, 65, when I retire, I suddenly get a lot of money from Provident Fund, NPS, or whatever it is. And then who has access to this data? The bank employees. First thing I'll get a call from them.
Correct.
And then they'll start mis-selling. So what can a person do to sort of protect for an emergency, right? Emergency fund is one thing, but from the age of 50 to 70, very high chance that I might get an unfortunate medical situation. Could be a accident, hospitalization, cancer, heart attack, diabetes, n number of things. So what do you typically recommend your clients on that front?
Yeah, so as far as today medical costs are concerned, we all know what the medical costs are. So having a proper medical insurance cover to the extent required is absolutely necessary. I mean, the base minimum is 5 lakhs. 5 lakhs is not really a major sum today, and you have super top-ups today, and at a very low cost you can go up to 30, 40, 50 lakhs, even 1 crore you can go.
Yeah.
So if you are able to get that kind of a cover at a comparatively earlier age, may not be, I mean, at 60 it's going to be rather difficult, because this is a human body, I mean, all kinds of problems start coming once you are crossing 40, 45,
Yeah.
diabetes to blood pressure to everything starts coming up. So earlier you take, the better it is, and it is not that earlier years you won't get a medical condition where you may have to be hospitalized. So it's a great idea to have a medical insurance at the early part of your life and continue that into the later part of your life. Getting a medical insurance and getting your application itself approved, medical underwriting, is going to be very, very challenging at 55 or 60. Because for sure, if they go for some medical test, something will come up, and either they are going to increase your premium dramatically, or they are going to directly reject the medicals itself. So to start with, the first thing I will say is, in your 40s at least, you get a proper medical insurance along with a super top-up for your entire family.
About how much amount you recommend?
I would say if somebody goes for a family insurance, 25 lakhs and above.
For the whole family?
For the whole family.
25 lakhs?
25 lakhs and more. So for the whole family. See, again, a lot of people have parents who are not really having medical insurance. So as much as possible, if it is possible for that medical insurance to cover the parents at a reasonable cost, that is also a good idea. If that is not possible,
it's usually advised to have separate policies for parents and yourself, right?
True. So you're right. But in some of the cases, some of the companies allow you to also take in your parents and other elders in the family
at a reasonable cost.
At a reasonable cost. So if it is available, then you cover. Otherwise, for people who are in service, you put them under the group medical insurance, even assuming you have to pay a certain amount of money.
Right.
Because some companies cover them up to a certain limit at no cost to the employee.
Right.
But some companies say that beyond this level of cover, let us say 5 lakhs of cover, if you want to cover your parents or other in-laws or other people, you pay the premium. So it may be a great idea to pay the premium, even assuming it is a company policy. And some companies also allow you to take the policy on your own, I mean, as an individual policy, once you superannuate. So at 58 or 60, when you're superannuating, at that time you...
What does that mean, superannuation?
Meaning when you retire. The typical normal retirement.
Okay.
So when you typically retire, at that time, it can convert into an individual policy, and you continue to pay the premium. The company was all along paying the premium, and you continue to pay the premium, and you continue that policy.
And what about critical illness cover? Like, because cancer is increasing, heart attack is increasing, how do we protect ourselves from that? Especially our parents.
Yeah.
And, a lot of, people worry about that, because my father is turning 60, 65. How do I protect him?
Yeah, so what happens as far as critical illness is concerned, see, there are certain illnesses which are classified as critical illnesses. But those are not it is classified as critical illnesses based on the incidence and based on how much money you may have to spend on that. Okay, and based on the severity of how it impacts a human body. But those are not the only 15 or 20 critical illnesses which a body can have. There can be many, many more.
Interesting.
So critical illness policy is a very narrow kind of a policy. It's, in my opinion, it's a good to have policy, because One may not have cancer, one may have something else which is of major significance from their life trajectory point of view. It may be life threatening also, but that is not covered in a critical illness policy.
Like what?
Say something to do with your liver, something to do with your spleen, something to do with your pancreas and things like that, which may not be cancer.
Okay.
May not be covered under the critical illnesses, because critical illnesses, they list it out.
Yeah.
So 15, 20, 25, whatever. So if it is not coming under that, they will not cover. So one of the ways of handling this is to have a good medical insurance policy of, let us say, a fairly good sum assured. So when I say fairly good sum assured, 25 lakhs, like I said, for the family or above. So if you have that, then it covers the critical illness also.
Oh, really?
Yeah, it covers.
Okay. If the cover is big, then this will also come under that.
Yeah, this
I
will
don't
also
need to take a separate policy
Yes.
as such. Okay. So
And-
basically, if, let's say, for example, in my family, let's say there is a history of diabetes, heart attack, high cholesterol, or cancer, and I know that it has happened in my family or my, far relatives, I know it is a possibility in my DNA. So if that is the case, and I know that if it ever happens to me or anybody in my family, it significantly impacts the income coming into the family, I can hedge it by taking like a critical illness cover. So in case something happens, financially, me and my family are protected because an income is coming into my family to take care of my ongoing expenses like chemotherapy or whatever it is. Plus I'll get a cushion, like a big lump sum.
Yeah, Sharan, in the case of critical illness insurance, once there is an incident, for example, of cancer, stage 4, if the sum assured is, let us say, 20 lakhs,
Yeah.
the company will pay 20 lakhs and the policy closes.
Okay.
It is not like your medical insurance policy, which will continue if you pay the
Oh.
premium.
Okay.
The policy closes. So that is why I said it's good to have. It has a limited potential to serve a client.
But who will pay for my ongoing expenses?
That is not the mandate of the critical illness policy. I mean, it does give at the onset of that particular condition, critical
It'll give me a
illness,
sudden lump sum.
it will give you a lump sum. So, so it is only partially useful.
But my health insurance cover will continue even if I get cancer, diabetes or
Yeah,
anything.
if you have a sufficient sum assured, yeah, they will continue your medical insurance.
So let's say, for example, I have taken a 25 lakh health insurance coverage. I'm healthy. 10 years later, let's say you get heart attack or you get cancer. Will the health insurance company now say, Sharan, now you become risky. I'm going to increase your premiums now and I'm going to cancel also if you keep getting these kind of bills. Is that possible?
Once upon a time, maybe 15 years back, those things used to happen.
Okay.
No longer, because IRDA has very, very clearly mandated that you really cannot stop just because people have started claiming. Because normally what happens for a lot of people is that they've been paying premium for the first 15, 17, 20 years.
Yeah.
And the claims start coming at some intermediate point, and not all cases are cancer cases,
Right.
where a huge amount of money will be required.
Right.
So what is the whole concept of insurance? Insurance is a matter of large numbers, right?
Yeah.
So everybody is not going to claim. Out of 1 lakh people, maybe say 5,000 people may claim, and other people are really paying. So you have to manage that.
Right.
So what IRDAI has come up and said is that you really cannot, as long as you pay the premium
Yeah.
as a investor, as a customer, you really cannot be denied that cover any longer.
So in perpetuity, whatever expenses I have,
Yes.
they'll have to keep paying.
Yes.
So that's why it's good to have it when you're early.
Yes.
Got it. Interesting. All right. So we've covered about the risk management. Now let's go to the rich people, right, that you manage, right? Because you mentioned that you have clients who have 5 crores, 8 to 10 crores. So
20, 25, 40.
20, 25 also. 40 crore also. But have you observed any rich people mistakes?
Yeah, there are lots of rich people mistakes.
Okay.
Okay. So, good that you came to this particular point, because this is very pertinent and is happening. See, a lot of people are getting affluent, and this is happening with many very, very smart people, unfortunately. See, what is happening is there are a whole lot of people who have products to sell, and they are cornering these people who have fair amount of money,
Yeah.
and they say, we have a product. I mean, why are you going for a mutual fund which is for the Aam Aadmi? We have a product which is called PMS. We have a product which is called AIF. We have a structured product. We have this product, that product.
Yeah.
You can invest abroad. You can buy a house in Spain and things like that, right? So they say all that.
Yeah.
See, the whole point as far as investments is concerned is that there should be a reasonable amount of diversification. See, the risk of, let us say, a mutual fund is fairly known. Like for example, the underlying can be equity, debt, commodities and things like that.
Right.
In the case of an AIF, I mean, you don't even know what is the underlying product, and some of the products may not be exactly liquid, and you don't know the risks embedded in those investments.
Right.
So you take a risk in that product without really understanding the extent of risk and what is the reward you should be getting.
Right.
And most people talk about the wonderful returns that AIF has given in the past and things like that. I mean, you can always pick and choose, right? I can always pick and choose a mutual fund and say that this mutual fund has given 80% return.
Yeah.
I have examples of that. But every mutual fund in every scenario does not give 80% or 70%. The normal return is maybe 12 to 15%. That's what one can get.
So AIF, for people who don't understand, is like a mutual fund for rich people where minimum investment is 1 CR.
Yeah. So, I mean, so once they have 1 CR, so it is sold this way. They say, I mean, you don't have to invest in the regular product. We have a product where you can make a lot more money. So my only point is, number one, you have to look at the risk. Number two, is the diversification really called for? And number three, if you have so much money, you really want to make more return from the money. I mean, you should really be worried about protecting the capital.
Correct.
Instead of multiplying the money, 12-13%, I mean, compound it for 10 years and see where you will reach.
Right.
With even 12-13%.
Correct.
So why do you want to get into a product which from the point of view of the seller is very attractive? Maybe they'll get 3.5% incentive from that. Okay. As long as the product is there. Management fee and other fees.
Sure.
So, and you are taking huge risk, and typically many of these exotic products are not really that very tax efficient. So when you actually factor in all those things, it comes to, in a good scenario, it comes to very near what a mutual fund gives. And you have taken a much higher risk in a AIF kind of a product or any other exotic product, as opposed to what you would have taken in a very diversified product and a easy to understand product like a mutual fund. So my point is, rich people make this mistake because people are pampering their egos and they are selling products which they are claiming to be only for the upwardly mobile, the rich, and it is not for the arm janta. So and people fall for that trap. So I mean, so all kinds of things do happen. I mean, sitting here, it looks like investing abroad is a very attractive thing, and a lot of people want the rich people to invest abroad and things like that. You have to keep your eyes and ears open. I mean, financial literacy is very important. You may not be attracted to finance per se, but broadly understanding the domain of finance enough to ask at least the right questions is very, very important.
Yeah.
Otherwise, they are going to be...
So give me an investment recommendation for somebody who is rich watching this podcast. Let's say he has 10 crore portfolio. How would you divide this 10 crore for somebody who is rich and has taken care of all his short-term, near-term, medium-term goals, only looking at capital appreciation and passing on a legacy for his kids?
Yeah, the investment will be, a portion of it will be for setting up the income.
Yeah.
So roughly take it as 6-7 crores will go into setting up the income, right?
So 6-7 crores should be in safe assets to ensure that the income...
Comparatively safe assets, maybe 7 crores. It's only the balance we can invest for other purposes.
So what is that safe assets? Let's say FDs, bonds, NCDs.
Either FDs, bonds, these kind of things, or it can be hybrid assets.
Yeah.
So it can be something like where it is predominantly debt and maybe arbitrage.
So equity,
or debt and some equity. Yeah, equity savings fund. Those kind of things. Again, it has to be properly done. I mean, basically, we will have to give some time for equity savings fund. Anything that is having equity, we will have to give at least 2-3 years for it to really come to a point where we can actually draw an income from that. So it has to be properly, carefully constructed, and we have to work in a nuanced manner.
So now let's come to the next level. Now somebody has come to you with 20 crores. What is your investment recommendation for somebody with 20 crores?
Yeah. One of the very important things for people who are beyond a certain level is to pass on a legacy without the next generation messing it up.
Yeah.
Okay. So I mean, one of the things which we suggest for these kind of people is to consider forming a trust. So you can set up a trust in a manner where the carefully constructed wealth of that previous generation is not undone completely by the next generation. So to some extent, they will be able to take that money, and if the person from the previous generation wants to set up for the grandchildren and things like that, that can be done through a trust.
Okay. Got it. But in terms of investments, my asset allocation, investment strategy,
So
because you mentioned staying away from exotic products like PMS, AIFs. So
no, I'm see. Let me not say that PMS AIF are bad. I'm not really saying that. But
Okay.
the way it is sold is that they say you are a wealthy person. Why are you investing in mutual fund? I don't agree with that.
Okay.
So there may be some PMS, there may be some AIF. I want to keep my eyes open for my client, and I want to recommend what is appropriate. I want to look at the charges.
Right.
I want to look at what the client will get.
Yeah.
I mean, most of these products are unfortunately sold, and it is not necessarily in the best interest of the client, and that is where I have a problem. See, as a financial advisor, I am product agnostic. I have nothing for or against mutual fund, nothing for or against PMS or any other product. As long as it makes sense, I will suggest that product to my client. And in future, if PMS happens to be the right product, I will suggest a lot of PMSs
Right.
for the appropriate category.
Got it. And so essentially, in terms of the product diversification, even for a rich person, you will still have mutual funds, and if it makes sense, PMS and AIFs. But what about some exotic real estate products?
In fact, we go against exotic products or very complicated products, which sometimes even the advisors don't understand. So one of the things which we tend to recommend to people above a certain level is REIT.
What is that level?
I mean, for the sake of convenience, we have said broadly, loosely about 6 crores.
Above 6 crore?
Above 6 crores, REITs.
REITs.
Yeah.
If somebody has more than
Real
6
Estate
crore?
Investment Trust, yeah. Typically, we start investing in REITs for them. We normally go for listed REITs.
Okay.
So that
But
is
there
one.
are only 4 or 5 options.
Absolute. Currently, it's an evolving market. But if you look at the REIT market, it has developed into about a 2.3 lakh crore market today. It's not so small, but you are absolutely right in your observation. There are only 5. So somebody who is okay with a 7 to 9% kind of return should consider this. So sometimes they may get even a double-digit return, 10%, 11% kind of return. But we normally suggest guidance of 7 to 9% return. So it's a good diversifier.
So this is a hedge for your equity portfolio because they're unlinked.
Absolutely. And the other thing which I would suggest for people is investments abroad through the medium of ETFs.
Yeah.
If you look at US market, the active funds are not doing well at all.
Right.
In fact, if you look at the ETFs in the US, the amount of money that is flowing into passively managed ETFs are much, much, much higher as compared to actively managed ETFs. That is the reality. So instead of trying to pick up a Meta or a Apple or any other Netflix or something like that individually, you better invest in NASDAQ 100. So we are suggesting those kind of investments to our clients to get that diversification. Previously, we used to suggest Indian mutual funds, which directly invest in some fund abroad, or which invest in NASDAQ 100 or S&P 500 or something like that.
Like the Franklin US feeder fund. All
Correct,
of those kind
correct.
of funds.
So something like that. But Franklin feeder fund is not exactly a passive fund. It is feeding into, it's a fund of fund, and it is feeding into a fund which is actively managed. But I am all for a fund which is passively managed. Let us say a Vanguard, or let us say some other fund, BlackRock fund or whatever.
Yeah.
Where the money which is collected here is directly redirected to that particular fund, which is passively managed. So the charges are very low.
Got it. Perfect. I think, Suresh ji, now it's time to go for the rapid fire round. All right, let's start. Question number 1. Most promising asset class in 2026?
It is the evergreen equity.
Looking at the next 10 years globally, what is the single biggest threat to an Indian retiree?
The typical threat is today loss of a job. Today, people cannot assume that they will have a job till 60.
Yeah.
So corpus building can be a challenge. So that will be problem number 1.
One atypical asset class that you like investing in, especially for this year, 2026?
I would say REIT.
REIT, REITs.
Yes.
If you had to park money for just 3 years, what is the best investment according to you?
3 years is difficult. Probably a hybrid kind of a fund is what I would suggest, because very difficult, or a multi-asset fund is what I would suggest. Difficult to predict what will be the trajectory of various asset classes. So hybrid or multi-asset.
What is the biggest risk to India's growth story?
The biggest risk is not having enough jobs, enough high-paying jobs for the aspirational youth.
One portfolio change every investor should consider this year.
I would say balance out your portfolio and have an appropriate allocation of the assets as per your particular family requirements.
The last question is, Suresh ji, who is that one future guest that you would like to recommend to come on this channel next, who you really admire for the work that they do in finance?
I think Harsh Runta is your guy.
All right. Harsh Runta, we are going to be calling you very, very soon. On that note, guys, if you've been watching until this long, I'm sure you enjoyed the conversation, the stories that we've heard, the mistakes that people are making when it comes to managing their money has, I'm sure, been eye-opening if you've been listening until this long. And Suresh ji, thank you so much for coming out over here and sharing your words of wisdom from your 22 years of experience of managing money for Indian citizens. And guys, if there was any questions that you felt like I did not ask and you want me to deep dive into, would love to hear about them in the comment section below so that I can be a better podcaster. And any future guest recommendations that you have, please drop them down below so that I can get you them very, very soon. On that note, I'll see you in the next one.
Before you go, guys, if this episode gave you even one insight that made you think differently about money, don't just keep it to yourself. Share it with your friend or family member who could use it too. And if it sparked a new thought or even made you disagree with me, drop a comment below and tell me why. Your critique helps me make these conversations sharper and more useful for you. As long as you have me subscribed, I'll make sure that you walk away with at least one new thing every Wednesday.